Hello and welcome to episode 518 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leakes. Damien, welcome back. And actually it's been a couple of weeks since we've been here in the studio.
Yeah, so it's good to see your smiling face again, Andy, because people might not realise, although we had a break last week on the podcast, Andy and I haven't recorded a podcast together for a few weeks now because we did record in advance of our holidays. So it's good to see you, Andy. I mean, I had a nice break. I went away to Menorca for a week, which was lovely, great weather, and had a really good time with the family. And I know you were away too, but unfortunately you got the flu as well, didn't you? So it's equally good to see you back up on your feet.
Yeah, I did get the flu, and it's one of those things when you run down, because on holiday, as much as you do enjoy yourself, you're kind of flitting about here, there and everywhere trying to make and maximise the time with the family. So yeah, just towards the end of the holiday I come down with it, but I'm all good now and all raring to go. And there's nothing better than recovering from the flu, because you kind of feel the best you've ever felt. Oh, and by the way, you also lose the weight that you put on during the holiday, which is an added bonus for me.
I always wonder whether it's a case of, I find going on holiday stressful. There'll be people listening to this podcast who think I'm odd, but because you're trying to get everything done, and you've just had a bit of insight there as to one thing that I have to do is we tend to record a number of podcasts in advance. It does mean that work becomes very intense just before you go away. So sometimes I actually do go on holiday and feel a little bit rough anyway. But moving on from that, what's on this week's show? I'm going to be doing something slightly different. We've done that quite a lot recently. I feel like I'm always saying we're doing something a little bit different, but we've not talked about investing in terms of investment markets and what's been going on for quite some time. So I did have the Damien's midweek markets, which then became a monthly feature. Now, we haven't done that for a while because we parked it, but I want to do a bit of an update on investment markets, what's been going on this year. So if you're looking at your portfolios and you've seen a lot happening and things that are perhaps slightly different to what you're used to. For example, UK equities have had a great year so far. I want to sort of discuss what's been going on with the markets and what I'm looking at going forward, and perhaps what could be the big market movers, the triggers, the catalysts in the coming weeks and months as we head into the year end.
Okay, so that's it. Holidays are done. We're back into the swing of doing the podcast. And actually, it's perfect timing for doing an investment piece, Damien, because everyone else has also been on holiday and kind of parked that for a little while. And now's the perfect time to get back into investing, see what's happening with the markets. And you're going to tell us what's been going on.
So Andy's right, because we do see this summer lull. And just as a bit of insight, if you ever look at your investment portfolios over the summer months, particularly August, then what you tend to see, there's an uptick in volatility. So you'll get some quite big swings on some days, and occasionally you might not really know why that is. And often it's because there's a lot less trading going on. So there's less people in the market. It links back to that old adage of selling May, go away, come back and St. Leger's Day. So when there's less people in the market, less money moving around, then when you get some sizable moves or people get a little bit spooked about something, then you can see that the volatility picks up because any trades have an outsized influence on the market at that point. So that's why you sometimes see quite volatile days during the summer months. So we did see some of that, and I'm going to talk about that a little bit later. But what I want to do is give a bit of a whistle-stop tour as to where we are now in 2025. So we've had quite a volatile year. We've had Donald Trump in particular having a major impact on markets. But I'm just going to go through the top performing markets at the moment. So I'm just looking at the numbers here at the moment. It may surprise people who don't look at their portfolio regularly, and a pat on the back if that's you, because you shouldn't be fussing over your portfolios from day to day. But the best performing market of the major markets that I'm looking at is the German market, up 24% year to date. And then if we move down, we've got the Hang Seng Index, which is the Hong Kong stock market. That's up 18.5%. Now, this is taking into account currency moves. So one thing you have to bear in mind is that the pound has strengthened against a number of currencies, but particularly the dollar. So it's strengthened against the dollar, more down to the fact the dollar has been weakening. So that pairing has the pound strengthened, the dollar's weakened. The pound's actually strengthened more than 7% against the dollar year to date. So that's had a big impact on returns. So you'll notice that as I start to go down here. So European equities, as measured by the FTSE Euro First 300 is up about 16% year to date. Then we've got the FTSE 100 up 15%. Emerging markets up around about 11%, and Asian equities up around about 11.5%. I'm using broad indices to give you these numbers, but this is just to give you a steer of what parts of your portfolio have been working really well. You've got Chinese equities, mainland Chinese equities up about 10%. You've got the Nikkei 225 has finally started to play catch up. It's up 5% after a very strong August. You've got the Nasdaq 100 up about 3.8%. Now the S&P 500, which is much broader than the Nasdaq 100, which is very tech focused, that S&P 500 is up about 2.85% as we make this show, while the Dow Jones Composite average is down 1.1%. So if you listen to that, you will notice that being in UK equities has been a good move this year, and European equities versus US equities, which have lagged significantly. Now, there are a couple of reasons why US equities have lagged, and I'll come on to them, but just to give you a hint, Donald Trump's trade war, but also the weaker dollar. So when the dollar has weakened significantly, it means that any US assets that you have therefore underperform when you convert them back into pounds. So if you own a US asset, it will be denominated in US dollars. When you convert that back into pounds, then you take a hit. So it does impact your holdings in your portfolio. So where in past years, US equities have been the stars of your portfolio, driving your portfolio hopefully to new highs, it hasn't been the case in 2025, which is very different. So with that being said, I want to give you a quick whistle-stop tour of what's happened year to date, and it will explain some of those performances that we've seen in stock markets. So if you go back to the first quarter of this year, so January to March, what we had were rising tensions, and then we started to get the divergence in markets. Now, if you look at the beginning of the year, so we focus just on January, it's quite interesting because you have the January barometer. So we had European and UK equity markets starting to move towards all-time highs. US markets were doing well as well. With the January barometer, what's interesting, if you have a positive January, it tends to predict you're going to have a positive entire year. So this year, January was positive on the S&P 500, and with an historic accuracy rate of 83.8%, then that suggests, this is going back to 1950, that the whole of 2025 was going to be particularly positive for US equities. Now, that has seemingly started to turn out to be the case. It certainly wasn't for quite some time. And if you look at the investment banks, their prediction for where the S&P 500 would end up at the end of the year was 6,635 if you took an average. Now, at the moment, we're at 6,450. It suggests we could have a bit more room to go. Now, those predictions are notoriously inaccurate and they seldom come to fruition. You've got to bear in mind that an investment bank's job is to invest client money. And if you start predicting that investment markets are going to crash, that's not going to be particularly good for business. So we came out of that first quarter in relatively positive mood. The one thing we did see is we saw the birth of a new Chinese AI model called DeepSeek, and that started to cause a few wobbles in the whole AI theme. So we saw Nvidia, which is the chip maker, have a wobble back in that first quarter because the idea was that the Chinese model required less processing power, so it would require less chips, which would be bad for business for Nvidia. And it did start to knock the whole AI theme because people were thinking there are lots of companies in the US investing lots and lots of money into AI infrastructure, and it seemed that the Chinese model was going to be a lot cheaper to run, and it undermined that whole premise of you need to invest a lot of money in data centers and everything like that to be able to make AI work and become profitable. So that was something that was in the background, but we moved on into the second quarter, still in pretty positive mood. And if you look at the stock market indices on your market apps that you use, you'll notice the big dip that we had this year. The market sell-off occurred at the beginning of April. And of course, that was the Liberation Day, as Donald Trump called it, where he announced his reciprocal tariffs. That hit the market pretty hard, and we saw markets slump with some of the worst days in years. So we had the VIX, which is often called the market fear index, rise to levels we hadn't seen since the financial crisis. And we saw, therefore, some of the worst days in terms of stock market performance, particularly in the US, since those days of the financial crisis. So we had a sell-off. The market eventually started to rebound once Donald Trump started to delay some of the deadlines surrounding the imposition of his trade tariffs. So then we got to April and the market started to rebound. And since then, the market has been in much of a buy the dip mentality. So you've seen investors, whenever the stock markets have dipped, they've started to buy back into them. Now, around about that period, so we're talking about going into May, the US stock market had massively underperformed lots of other stock markets, particularly the FTSE 100 and European equities as well. So the FTSE 100 was outperforming, which hasn't happened for years because it has a lack of tech exposure. So we saw a wobble in tech stocks and we saw US stocks sell off as people started to feel that the US was more risky when it came to investing, them allocating their money elsewhere. The UK benefited from that. So the FTSE 100 was outperforming. Partly that was because it has a lack of tech exposure. So when we saw the wobble in US tech stocks, it didn't bleed over into the UK. But also there was the volatility in US assets generally, which was a result of Donald Trump's trade war and his seemingly random policy decisions at times. But then that meant that it was to the benefit of European equities and UK equities as well, as people started to allocate their money to other places outside of the US. But also what we saw is a reflection of central bank policy. So there was a divergence that started to occur because the UK, we saw rate cuts by the Bank of England. We saw a similar thing happening with the European Central Bank. So when you tend to get central banks being accommodative with their policy, so they start to cut rates, for example, that then is usually good for the domestic stock market. So we're talking about risk assets. So in the UK, that is, for example, equities. And in the US, the Fed, the US Federal Reserve, wasn't as accommodative. It was paused its rate cutting. So we were at a stage where the Bank of England and the European Central Bank was seen as more accommodative, more dovish than the Fed. But we even had the Bank of Japan, people were thinking they were going to hike rates. So if you looked at that point at how equity markets were performing, you could have done a list almost from the most accommodative central banks, which would have been the best performing domestic stock markets, down to the least accommodative, or deemed to be the least accommodative, and they would have been the worst performing stock markets. So that just shows you, despite some of the other things that were going on in the macro backdrop, sometimes it is just down to what central banks are doing. And that's continued actually through the summer, and I'm going to come on to that. Now, the other big thing that impacted the first half of 2025 is the dollar. Now, if you've watched past episodes of Damien's Market Update, I often talk about the importance of the US dollar. If you get the dollar right, the direction of travel, you tend to get the direction of most assets right. So if the dollar falls, you tend to see things like gold do well, and gold has been one of the best performing assets, bar none almost, year to date. It's outperformed the US stock market, for example. And if you look at things like commodities, they tend to do better when the dollar falls. Emerging market assets tend to do better when the dollar falls. And if you look at or go back and listen to what I spoke about at the beginning of the podcast and listed the best performing market, there were things like emerging markets that were outperforming. Now, interestingly, it tends to be a tailwind for US stocks too, but because of what was going on with Donald Trump and the trade war, that actually hit sentiment more broadly. So we didn't see US equities get the same pickup that you would normally expect. So these things don't always work in lockstep. It isn't guaranteed, but it is interesting to note that the fall in the US dollar, which we saw a slump in the US dollar after Trump took office the first time around. Now, this time around, if you go back and read some of the notes, if you're an 80/20 investor member that I wrote at the beginning of the year, speculated, would we get another dollar slump like we did back during Trump's first presidency after he took office? And we've seen a major sell-off in the dollar. Now, going forward, if you're interested, get your stock app out and look at the US dollar index, which measures the value or the strength of the dollar against a basket of other major currencies. At the moment, it's about 98. And there is a level about 97.7 that I'm watching all the time, because we've fallen down to that level, and that is a long-term support point. So there's a support line that goes back a long time. If we break below 97.7, it could signal we're going to get more weakness. And what that means is that if markets behave as they had done in the first half of the year and the way they behaved in reaction to a weaker dollar, we could see a lot of what we saw in the first 6 months of this year repeat in the second half of this year. And that's kind of what we have seen, to be honest, as the summer's unfolded. The other thing we've seen moving into the second half of the year and now through into the autumn is the taco trade. So TACO, Trump always chickens out. So when we had the sell-off, when Trump announced all these trade tariffs, we got to the stage where the market started betting that he would always reverse course, or he would delay the implementation of any trade tariffs. And that's played out time and time again. So the taco trade was where traders and investors were banking on the fact that Trump would eventually change course and delay. And we have seen that play out. So what happened is that we got to a situation where investors are buying all the dips in equity markets because they believe that Trump will, of course, just chicken out. And so that continues to be the case. And so the trade war has taken a bit of a back seat as a driving force behind markets. It still does influence it, but we've had a number of trade deals that have been announced, but also we've had a bit of a truce between the US and China. So for now, Trump's influence on markets has taken a little bit of a back seat, but that's because investors stopped believing him. And it means that as we go into the autumn, the big driver at the moment of markets is the expectation or anticipation of what central banks will do. So the Fed and the Bank of England and the European Central Bank will soon be announcing their next policy decisions. And in September in particular, the Fed and the Bank of England will be crucial, particularly the Fed. Now, the Fed meets on the 16th to 17th of September. That's probably the biggie, because we had something called the Jackson Hole Symposium, which happens in America, where central bankers all get together and chat. And normally what happens is you get a soundbite or two from central bankers, and particularly Jerome Powell, who's the chair of the US Federal Reserve, often will say something and it will give markets a hint to what the Fed might be thinking. And in the recent Jackson Hole Symposium, which happened a couple of weeks ago, he did hint at the fact that the Fed would likely be moving to cutting rates again. And that caused the market to get excited. There was euphoria. The markets rallied. Stock markets shot up. And that's because easy money is obviously good for risk assets, and they will be supporting the market. So we're at the point now where you'll hear another phrase probably, which is that bad news is good news. So we've got to that weird stage that bad economic news is deemed positive for stock markets, because it means that the central banks will step in particular the US Federal Reserve when we're talking about America. And that seems to be where we are now. But the problem is that central banks have had an issue with inflation proving sticky, and that's still the case in the UK, and it is still the case in the US to a certain degree. So that clouds things. So we've been in a position where in the US we were given a green light, seemingly, for rate cuts in September from the Federal Reserve, Jerome Powell in particular. And we've had a similar thing in the UK previously, where Andrew Bailey, the governor of the Bank of England, suggested that we were probably going to see more rate cuts. But given what's happened with the trade war, inflation, and something I'm going to come on to, but fiscal conditions, so fiscal policy in the US and in the UK, it's muddied the waters a bit. So we're probably on a bit more of an amber light than a green light for rate cuts in September, but it's probably, well, the market is pricing it's likely to happen. So if it doesn't, then that could cause a wobble, because markets are pricing in this anticipation of more rate cuts in the UK, but particularly in the US. So that's what we're watching if you're into investing. September is going to be interesting. Now, normally, August and September are quite negative months when it comes to investing. They're two of the worst months when you're looking at stock markets historically. Yeah, history doesn't always repeat, but it often rhymes. Now, we had a very good August, and we've had a very good summer. So anybody who sold in May and went away, St. Leger's Day just is next week. So unless we have a big sell-off, then it looks like that the selling may and go away adage didn't work this year. So we are at the point now where markets have been very positive. And there'll be people worried about, does that mean we're going to get a slump? I don't know the answer to that, but all I can say is that all-time highs are generally a positive thing. And recent history has shown if we have a strong summer, then we tend to continue that into the year end. That's not guaranteed. Very much things depend on what's going to happen with central banks and obviously inflation and economic conditions and obviously Donald Trump's trade war. So I would keep an eye on the dollar. That is something that is going to probably dictate a lot of what happens. And of course, that's going to be influenced by what the US Federal Reserve does. But in the background, we've had some wobbles in recent weeks, one of them around the AI trade. So there were concerns that the AI theme was a bit bloated, that we're getting very high valuations and that companies weren't ever going to get any profit back. And there was a report by MIT that suggested that 95% of companies that are investing in AI have yet to see any kind of profit from that investment. So we've had a little bit of froth taken from the market. And of course, those AI stocks have been driving markets higher in recent months. So where the US was underperforming as we got in through the first half of 2025, US stock markets generally have been some of the best performers in recent months, as we've seen investors flock back into those stocks and they rebound. Now, as a UK investor, currency moves have still meant that you've not seen a lot of return from the rally in US tech stocks, but it is something to bear in mind that people have started to move back into them. We'll see how that continues through the rest of the year. Now, one thing I want to talk about is the bond market, in particular government bonds. In recent weeks, we've seen the yields on government bonds rally, not just in the UK. So we've seen gilt yields rise. We're talking principally at the longer end. So we're looking at things like 30-year gilts and 10-year gilts to a certain degree as well. They've risen, and that started to put pressure on the Chancellor, for example. She's got a budget coming up. It's been announced to be on the 26th of November. That's going to be a big fiscal event. So we're at the stage in the UK where it seems the Chancellor is struggling to balance the books. Is she going to have to borrow more money? That could cause yields to rise further, could cause a bit of a bond market wobble. We've had that in the past, a tantrum, and we don't really want to see that again. But we've started to see the bond issue, the rise in yields, bleed over into equity markets in the last week or so, and it started to cause a bit of a wobble. If you get a bond market tantrum, so government bonds are deemed among the safest investments out there. It does depend obviously on the government, but if you're talking about UK gilts and treasuries, think of a skyscraper and where you've got the foundations are cash and then you've got bonds on top of that. Then equity markets, and thinking things like emerging markets, as you further you go up that building, become riskier and riskier. The riskier assets are on the top, so things like stocks. And as the foundations wobble, if you get a wobble in bond markets, it will cause the whole building to fall and could ultimately fall down. So that's the way to think of a bond market wobble and why it can have a big impact on equity markets. We've seen a few tremors in equity markets this week, actually, as a result of the rise in yields and government bond. But it's not just a UK thing. So it's been something we've seen globally in developed markets. And it's a symptom of, it's not just inflation, because that tends to impact shorter term government bond yields, but it's been as a result of the increased borrowing that governments are having to take on to balance the books. And so that has started to be called into question, and it's starting to see investors wanting to be paid more for loaning money to governments for a long period of time. And in the US, we've seen Donald Trump announce even more spending. So it's a similar thing over there. So in the coming months, I think fiscal policy could be something we're talking about. And it could be we're talking about bond markets once again, in particular government bonds, and how that starts to impact equity markets. So as we move into the last few months of the year, we could see a bit of a tantrum in bond markets. And if you look at the August best performing sectors, UK gilts were at the bottom. They're the worst performing markets, and in particular index linked gilts. So index linked gilts have very long duration, and that's a measure of the sensitivity to movements in interest rates. So as we've seen yields go up, for example, then things with longer duration have been impacted to a greater extent, and the value of them has fallen. In short, investing in index-linked gilts hasn't been a good place to be in the last month or so. So that could continue into the rest of the year. It depends. unless we see a rebound in government bond markets so people start to buy them again. So where am I investing? So people might be interested to see how I've allocated my 50k portfolio that I run for 80/20 investor members. I say it's 50k. I've been running it for over 10 years now, and I'm just shy of 100% profit. And I'm particularly pleased about how well I've done with my portfolio. Interestingly, I've been running my portfolio now for over 10 years, and I say it's a 50k portfolio, but it's now almost doubled in value. And if it resided in the mixed shares 40 to 85% sector for unit trust. So if I was a fund manager being paid lots of money to run it as a fund that other investors could invest in, then out of the 100 and I think it's 40 odd funds that have been around for that 10-year period, then I'd be ranked 26th on that list. Now, that is for me an incredible achievement, given that I only have around 60 to 65% equity exposure in my portfolio. And in the past, I've had as low as 40% exposure. And you have to remember that a lot of the funds in that sector will have up to 80% exposure. And you have to bear in mind that the more equity risk you take over the long term, you should outperform. So if you're taking 80% equity risk, then you should outperform somebody with 60% equity risk if you're good at what you do. Now, my portfolio, if it was a fund, has outperformed funds which have a total of £70 billion invested with them. So investors in the UK, ordinary investors that invest with fund managers, they have £70 billion worth that's underperforming mine. And now that sounds a bit of a boast, and I don't talk about it enough, actually. So forgive me if it is, but if you are interested in 80/20 Investor, then do click on the link in the show notes so you can take out a free trial and find out more about it. But I'm going to just tell you where I'm invested at the moment. Now, this isn't a recommendation. Don't just follow me blindly, but just so people know how I've done so well this year in my portfolio. Now, I do have about a 5 to 6% exposure to gold continually, and gold has been one of the best performing assets year to date. At one point, it was up over 30%. I have about 15% in UK equities at the moment. It is one of the larger holdings. North American equities is down to around about 10 to 11%. Then I've got Asian equities and Chinese equities and emerging market equities, which each have around about 4% exposure. So you can see I have quite an exposure to emerging markets at the moment, and Japanese equities are about 6%, and then European equities is the second biggest holding that I have at 14%. Now, I'm not going to go through all the other equity exposure geographies or the other assets that I'm invested in, but it's just to give you a feel that as I've moved my portfolio and tweaked and changed to take advantage of the momentum that's been in the market, it has helped me outperform. So that makeup is quite different to what I've had in the past, because typically US equities have been the largest component of my portfolio. And if you're invested in a multi-asset fund from that sector, for example, that's been underperforming, it may be because it has a significant exposure to US equities, and it could be as well because of the gilt exposure that it might have, or the government bond exposure as it's underperformed. My portfolio's low risk funds tend to be split between target absolute return funds and some high yield funds as well. And don't forget, high yield bond funds tend to do well when equity markets do well. So that just gives you a kind of a feel of where I am at the moment. It's just to show you that I don't talk about this stuff just hypothetically, that we do actually live it, and you can see me invest my own money live on 80/20 Investor.
Okay, so that's a pretty thorough rundown of what's been going on in investment markets over the last few months or so. How can investors who perhaps don't take an active role in their investment journey, or perhaps haven't yet got into investing, how can they take heed of the information in this week's podcast?
I think the most interesting thing is to, when you watch the news, is to think about how that impacts you personally. So yes, people might see Donald Trump on the news and think it doesn't impact them, but it does materially impact you. So I gave the example of gilt yields there that were rising. Well, one of the byproducts of rising gilt yields is it can start to influence mortgage rates, but it, more importantly, influences annuity rates. So at the moment, annuity rates are particularly attractive. And one of the reasons that yields have been rising is not just because of what's going on in the UK, but also in the US. And so that has an influence on what's happening to somebody who might be wanting to buy an annuity, but that might not even be thinking about investing. it also starts to impact things like inflation. But I think it's great from a personal finance perspective to see things on the news, then look at markets and see how does that impact them. It's just really seeing the moving parts. I suppose it's like having a car and having a basic understanding what's going on, but you don't need to get fully into it, perhaps as much as I would, but it helps you understand how things work. And for a passive investor, I think it's really important to realize that you do get these bouts of volatility and the reasons why they occur. Because if somebody had seen the sell-off that occurred in April after Donald Trump had announced his tariffs, they could have just bailed out the market if they'd started investing then, or they were a passive investor, if they just happened to check their portfolio. Understanding why things move and why things happen make you less frightened of them. It's like anything of life. It's like being scared of the dark. It's just me trying to turn the light on for people so they can understand why things move. And it's just part of the natural cycle of what happens, that we respond to, or investment markets respond to what's going on out in the real world, what happens in politics and what happens in economics, but not to get bogged down in the detail, but to understand if you're a long-term investor, then there is a strategy or process you should have and you stick to that. And in the long run, I'm talking about the very long run, we're talking into decades, that markets go up and they do recover. And if you're somebody who's got a pension, then you don't need to worry about what's happening this week, next week, this bull market, the next bear market, because you're going to live through many of them. You're going to live through another financial crisis and your portfolio will be invested through that. So I think what it gives people is just an understanding of why things happen. It might give them a bit of an interest. And don't forget, you can be a passive investor and take a slightly active approach with part of your money. There's no one size fits all. But on a completely separate note, if you're not even into investing, it might help you understand why when you went to Florida this year, you couldn't afford anything that you wanted to buy in the shops, and why currency movements are happening, because this is all interlinked. I find it fascinating. And if I could get people to try and understand how markets move, how it impacts them, and that it is all part of that natural movement of assets. If you want to build wealth, you do really need to start investing at some point. And it's quite nice, that nice sort of segue back to the podcast we did recently about how to make your children a millionaire. We had some great feedback on that episode, actually. So go and look at the Spotify reviews or comments on that episode. Somebody wrote a brilliant comment on there about the idea of long-term investing and understanding how it works and how they take advantage of it for their children. So if you listen to the podcast, then I just want to finish off by saying, do please go and leave a comment on the Spotify shows or on the app of choice, leave a review. And if you do leave it on the YouTube channel or Spotify, then we will reply to that comment.
Okay, so that's it. We are done for this week. Damien mentioned there about please commenting and make sure that you do subscribe in all the usual places, YouTube as well. Do, of course, sign up to the Money to the Masses newsletter. That goes out at 10 a.m. every Sunday. And within that email, you'll get a really easy to view list of all the stories that impact your finances. And you can sign up to that by going to moneytothemasses.com/weekly-newsletter.
Of course, don't forget to follow us on all our social channels. I'm doing more and more on our social channels and trying to push out lessons on Threads and X, formerly Twitter, although it's not my favourite social media platform, but I'm trying to teach people where they are, even very small lessons each day. Don't forget to follow us on Instagram and like and comment on everything we do. It really helps us. themoney.ai, that is the way you can get answers to your questions instantly. I love all your feedback on that. Please keep telling people about it. Please keep using it. It helps us to keep training the model in the background, because you've been asking a whole host of really interesting questions. I think next week we might pull up some of the questions that people have been asking it around all sorts of topics, including investing and mortgages. So that's something for a future podcast. It goes without saying, do join our Facebook group, facebook.com/groups/money to the masses, and do subscribe to our channel. So Andy, I think that is everything. Very investment heavy this week, but it was time. I think we hadn't done any market roundups for a very long time. So all that's left for us to do is to say until next time.
Until next time.